S&P 500 prints a highly deceptive 0.05% gain, closing at 7,411.98. The Dow tax on nearly 236 points, settling at 51,947.25, while the Nasdaq composite drops roughly 0.6% to finish at 24,975.82, or exactly 15 minutes past the closing bell on this Friday, July 24th, 2026.
And if you are just managing a book by looking at those headline numbers for this deep dive, I mean, you are actively trading blind right now.
Not completely blind, because if you look beneath the surface, over 60% of all U.S. issues actually advanced today. We saw real estate jump 2.3%.
Yeah.
Financials and industrials caught a tremendous bid into the close.
Yeah, the equal-weighted underbelly is holding up fine. It's the concentration risk that's snapping back.
Exactly. Information technology and semiconductors just got hammered.
Yeah.
I mean, the Philadelphia Semiconductor Index sank 3.1%.
Right.
So you have to ask, if over 60% of the market is green, why does this tape feel so incredibly heavy?
Because it's a structural mirage. I mean, you look at those closing prints, and it is a textbook head fake. The surface numbers are completely masking a violent structural rotation in the plumbing of the market.
Which is wild, right? Because the macro setup going into today was actually pristine for growth. It should have been jet fuel for tech.
On paper, sure. On paper, it was perfect.
Definitely on paper. I mean, we had Brent crude dropping nearly 4% today, down to 96.78 after that Thursday Middle East scare pushed it over 100.
Yeah, WTI fell right back into the 89 to 90 range.
Right. So energy drops, inflation fears immediately cool off, and the 10-year Treasury yield stabilizes near 4.68%. Consequently, implied volatility just gets crushed. The VIX settled all the way down around 18.80.
Which is a massive reprieve from Thursday.
Exactly. So in a normal market, when the 10-year yield stabilizes and oil drops, tech stocks rip higher. Why didn't we see a massive key reversal in tech today?
Because the volume confirmation isn't there. It's just not there. If you look at the intraday flow, institutional capital completely faded the rally.
They sold into that midday strength.
Exactly. They use that temporary pop as exit liquidity. I mean, no real money manager wants to hold massive, unhedged, high-beta tech exposure over a two-day weekend, not with lingering geopolitical friction and, random trade tariff headlines dropping.
So they de-risked.
They took chips off the table, yeah. They viewed Friday's stabilization as just a mechanical pause, not some durable cyclical bottom. It's just an environment of incredibly low conviction right now.
But the real risk here is how they de-risked. They dumped tech, but bought real estate and financials. And that brings us to the actual structural rotation we're dissecting today.
Oh.
Because the narrative has completely ripped away from macroeconomic inflation.
Oh, entirely. We are in the middle of a brutal AI CapEx interrogation.
That is the perfect way to phrase it, a CapEx interrogation. For 2 years, the market rewarded the promise of AI, right? You say you're buying GPUs, your stock goes up 10%.
Right, it was a blind gold rush.
But following Alphabet's increased spending guidance and Tesla's margin contraction, the mood has turned hostile. Investors are ruthlessly punishing elevated tech spending if there is no immediate return on investment. Let's look at Intel's closing print, ticker INTC.
Yeah, this is the poster child for the interrogation.
They absolutely crushed Q2 earnings. I mean, revenue came in at $16.1 billion versus $14.33 billion estimated. EPS was 42 cents against a 21-cent estimate. They doubled the street's EPS estimate.
It was a massive clean beat on the top and bottom.
But the stock reversed hard. It closed down over 6.5%, hovering right around 100.23.
Right.
Because on that exact same call, they raised their 2026 CapEx commitments to over $20 billion, citing skyrocketing memory chip expenses.
They stepped right into the trap. They essentially told investors, hey, bear with us. We are burning billions today to win a fabrication war in 2026.
And Wall Street slammed the sell button. But, I mean, why is that suddenly so toxic? Traditionally, the street rewards R&D. Amazon ran at a loss for years to build AWS, and the market cheered them on.
Yeah, but Amazon built AWS in a zero interest rate environment. When money is free, you can afford to wait 5 or 10 years for a payoff.
The duration preference.
Exactly.
Yeah.
The cost of capital is fundamentally different today. With the 10-year sitting near 4.68%, the hurdle rate for these investments is drastically higher. The market's patience has completely evaporated.
They want the receipts right now.
We are moving directly from the narrative phase of AI into the monetization phase. If you can't show immediate margin expansion, they will dump your stock.
Which perfectly frames our relative strength outlier today. Digital Realty, ticker DLR.
Oh, wow. What a chart today.
Right. While Intel got hammered, Digital Realty, which is a pure-play AI data center company, surged over 11%, defying all the tech weakness. They delivered a clean beat and raise.
Because of where they sit in the supply chain, Intel is asking for $20 billion to build the chips of tomorrow. Digital Realty has the physical temperature-controlled data centers built today.
The massive tech giants are literally paying them exorbitant rent right now to host their servers.
The immediate visible monetization. Institutions are happily paying a premium for infrastructure picks that have clear near-term cash flows. But they're completely unwilling to fund these vague, multi-year CapEx streams that wreck profit margins today.
So understanding that brutal interrogation, how is the smart money actually positioning for Monday's open? Because next week is the single busiest catalyst week of the summer. We have a Fed policy decision on Wednesday, plus a monster wall of earnings: Microsoft, Meta, Apple, Amazon.
It's a minefield. The day two play being aggressively recommended to institutional clients right now is a rotation strategy.
The capital isn't flaying the market.
No, it's just being violently rotated. You go long on the equal weight S&P or specific defensive value stocks, and you short the high capex tech volatility.
Right, boring companies. The strategy notes highlighted Verizon, ticker VZ, as a prime example. It caught a very strong upside bid on Friday after upgrading their full-year EPS to that 4.99 to 5.04 range.
It's a high-yield defensive telecom stock. It is the literal definition of a safe harbor.
It provides stability while the rest of the market tries to navigate this tech earnings storm.
But as this rotation happens, we really need to watch the structural plumbing because the technical levels are incredibly fragile going into Monday.
Yeah, let's talk about the options market structure.
Right.
The S&P 500 closed at 7,411.98. That puts it right on top of a massive gamma wall at the 7,400 level.
Right. And for anyone trading the flow data, that 7,400 strike is a structural tripwire for market makers.
Explain the delta hedging mechanics there, because it's critical.
Sure. So market makers who sold all those options don't want directional risk. They just want to collect the spread. To stay market neutral, they constantly buy and sell the underlying S&P 500 to hedge their books.
And right now, there is a massive concentration of those positions sitting exactly at 7,400.
Exactly. As long as the S&P stays above 7,400, that hedging activity actually compresses volatility. They buy dips and sell rips. It keeps the market in a tight, neutral range.
But if the S&P breaks cleanly below 7,400,
then the math completely flips. The gamma profile turns negative. The market maker's exposure accelerates against them, and they are mathematically forced to aggressively short the market to protect themselves.
it creates a mechanical feedback loop. The market drops, dealers have to sell, which forces the market lower, which forces more selling. It is purely structural.
Completely agnostic of fundamental news. If that dam breaks at 7,400, the dealer hedging could trigger a really fast, slippery slide down to the 7,350 to 7,380 support zone.
So 7,400 is the absolute line in the sand for the broader market. And on an individual stock level, the notes flag Intel again. It closed at 100.23. The psychological level there isn't even $100.
Right. If it holds 100 at the open, maybe we see a technical bounce as shorts cover.
But if it breaks below 100, we should expect capitulation down toward the 96 level.
Yeah. But synthesizing all of this, the geopolitical noise, the capex scrutiny, the options clustering, the probability of a major directional trend day on Monday is actually pretty low, only about 30 to 35%.
Meaning, you shouldn't expect the market to just confidently pick a single direction off the opening bell.
No, anticipate heavy, range-bound chop. Directional momentum strategies are going to face massive friction. Portfolio managers are just setting up their risk profiles ahead of Wednesday. They aren't placing huge, unhedged bets right before the Fed speaks.
So pulling this all together, the ultimate takeaway from this deep dive is that the market isn't crashing. It is decoupling. Capital is shifting out of multi-year AI dreams that lack immediate monetization and flowing directly into tangible, rate-sensitive value sectors.
The macro tailwinds that usually lift tech are being completely overpowered by the sudden demand for capital efficiency.
Which leaves us with one final, frankly terrifying question for next week. We've seen how aggressively Wall Street is punishing Intel for heavy AI spending without immediate returns.
Right, they lost 6.5% of their market cap despite doubling EPS.
Exactly. Well, next week, the absolute titans, Microsoft, Amazon, Meta, are stepping up to the microphone. These are the companies driving the entire AI narrative.
For hyperscalers.
Yeah, they're the ones buying the chips and building the data centers. So what happens if they fail to show the exact ROI the market is currently demanding?
Oh, it would be a bloodbath.
If Microsoft or Amazon can't prove that their tens of billions in AI capex is directly expanding their profit margins right now, Could this trigger a fundamental repricing of the entire AI revolution?
It wouldn't just be a stock market correction.
No, it extends deep into the real economy. If the Titans pull back on spending because Wall Street demands capital efficiency, we're looking at a freeze in tech hiring, a massive contraction in venture capital for AI startups, and a cascading slowdown across the entire broader tech ecosystem.
If institutional capital changes its mind on the timeline of AI monetization, the entire ecosystem is going to face a very painful reset.
Something to carefully manage your risk around as we head into Monday's opening bell. Watch the prints, track the volume, and keep your eyes on that 7,400 gamma wall.